Welcome to the TAC Index AI Podcast Weekend Edition, where we blend TAC IP data, reports, and charts with the latest news in all things logistics with a focus on air cargo. Okay, let's unpack this. For our deep dive today, we're zooming in on the air cargo market. What's the mission then for this deep dive?
Well, for you, our listener, the goal really is to take the very latest air cargo update from TAC Index and connect it directly to what's happening in the broader macro market. So that means looking at recent trade deals, breaking down these ongoing tariff tensions, and also uncovering the surprising resilience we're seeing in the wider shipping logistics sector. We're pulling insights from sources like Reuters, the Wall Street Journal, and the South China Morning Post, basically trying to give you a shortcut to understanding the critical stuff, those aha moments in this really dynamic landscape.
That's exactly it. That's what we're aiming for. So let's start with the global view, the big picture from TAC Index. Fresh data as of July 22nd, 2025. It shows global air freight rates were only slightly lower last week. The global Baltic Air Freight Index, that's the BAI 0, it dipped just 0.3% in the week ending July 21st. And what's really interesting, I think, is it's only marginally lower, just 0.8% from where it was like a whole year ago. That feels like a surprising amount of stability, doesn't it, given everything going on?
It really is, yeah. That stability in the global index is quite telling. With the market well into what's normally its quietest season, sources aren't really expecting any big price swings short term, and that's even with some worries still bubbling away about tariffs flaring up again. It kind of suggests a pretty strong underlying baseline, maybe more resilient than you'd think for this time of year.
Okay, right. So let's drill down a bit. Let's look at the regions, starting with Asia. The latest numbers show rates on the busiest lanes out of China were a bit lower. That's to both the U.S. and Europe. And those new BAI spot indices, the ones from Hong Kong to the U.S. and Europe, the ones just in public trial, they also showed a very slight dip over the week.
Yeah, and digging into that Asian picture a bit more, the overall index for outbound Hong Kong, the BAI 30, that's a key one. It was down only near 0.6% week on week, which leaves it about 6.1% lower than last year. Meanwhile, outbound Shanghai, the BAI 80, another huge hub, that saw a slightly bigger dip, 3.8% week on week. And it's also down by that same 3.8% compared to last year. Elsewhere in Asia, Vietnam rates were up a tiny bit again week on week to the U.S., but down to Europe. And still well down year on year both ways. India rates also lower again week on week and, quite a bit down year on year. So, yeah, kind of a mixed picture, but generally trending down slightly from those big hubs.
Okay. But here's where it gets really interesting, I think. Despite those dips we just talked about from the major hubs, rates from Bangkok and Seoul were both higher again on routes heading to Europe. And they're still way ahead compared to last year. That contrast is pretty stark, isn't it? What do you think might be driving those specific routes up while others are dipping? Seems localized.
It certainly does. Yeah, it really makes you look closer. It suggests something more specific is going on there. Maybe we're seeing a surge in demand for certain things going to Europe, like high value stuff, maybe high tech parts from Korea or specialized goods, perishables from Thailand that often go by air. Or it could be a strategic thing. Maybe some supply chains are shifting volumes through those specific gateways, could be changing trade lanes, or maybe just capacity issues elsewhere, pushing traffic through there.
Interesting possibilities. Okay, let's shift focus then. What about Europe?
Europe. Well, that's a much stronger story right now. Overall, rates were higher again on lanes going to the U.S., China, and Japan, and also on some newer lanes like India and South Africa. The index for outbound Frankfurt, the BAI 20, that's a major European hub. It gained a solid 5.9% just week on week, driven by higher rates to China and North America mainly. That pushes it up to a 10.5% gain year on year. Pretty healthy.
Wow, okay.
And London, the BAI 40, another key gateway, especially for Southeast Asia and North America, it also kept climbing. Boosted by a big surge in rates to Southeast Asia, it gained another 8.1% week on week, which helped take its year on year gain to a massive, get this, 44.1%.
44%.
Yeah, putting that index at its highest level in 2 years. So the big question is, what's making these European hubs so strong right now, showing these big gains when other places are quiet? Is it new trade patterns? Something else?
That is a fascinating question. And yeah, that London performance is really something else. All right, finally, let's touch on the U.S. perspective. Rates from the U.S. were higher again going to Europe and now well ahead year on year there, also up week on week to China. But interestingly, not to South America, even though there were gains on busy lanes out of Miami. The index for outbound Chicago, the BAI 50, that's a key inland hub, actually slipped a bit by 2.7% week on week, which leaves it lower by about 10.2% compared to last year. So what's the takeaway for the U.S. air cargo market Kind of mixed, it seems, but definitely stronger on those European lanes, which lines up with what you just said.
Definitely. Okay, so now let's zoom out from the air cargo details and try to connect this to the bigger picture. Global trade, the macro market. What's really interesting here, I think, is how these relatively small shifts in air cargo rates are happening while the wider global market is seeing some pretty significant moves. Mostly driven by all these trade talks. It's almost like, the air cargo sector is humming along quietly, even in its slow season, while the broader economy is buzzing.
That's a great point. And it ties right into that market optimism we've seen lately, right? S&P 500 hitting new highs, the Dow Jones rising, seems clearly fueled by hopes of new trade deals, like President Trump announcing pacts with the Philippines and Indonesia. For the Philippines, U.S. exports facing 0 tariffs, Indonesia eliminating most tariffs on U.S. goods, though the U.S. charges 19% on imports in both cases. But how much of this market buzz, would you say, is based on actual changes versus just the hope of deals, especially with other tensions still around?
That's the key tension, isn't it? And the market definitely reacted strongly to the hope, even more impactful in some sectors, like autos, that reported deal with Tokyo. Japan paying a lower 15% tariff on cars to the U.S., down from a potential 25%. That news sent Japan's Nikkei up 3.7%. Mazda shot up 18%. Toyota jumped 14%. Huge moves.
Wow.
And European shares climbed too, boosted by hopes for a US-EU agreement with negotiators coming over. The Euro CFTXX 600 jumped 1%. Auto shares surged 3.6%. Even UK shares hit a record high, up 0.5%. So the market is clearly pricing in less trade friction. That's what's driving the optimism.
Right. And adding to that positive feeling, Treasury Secretary Scott Bessent said trade with China was in a very good place, and that the current U.S.-China trade truce would likely get extended beyond August 12th. Chinese blue chips saw gains, too. So is this just the market betting on continued good news, or are there, hidden costs under the surface we're not seeing in the indices?
That is the million-dollar question, and our sources really highlight the answer. Because despite all this optimism you can feel in the markets, the source material also points to the very real, undeniable impact tariffs are having on company profits right now. General Motors, for instance, tumbled 8.1% after reporting a huge $1.1 billion hit from new tariffs.
Ouch.
Yeah. RTX fell 1.6% after lowering its forecast, blaming tariffs. And Lockheed Martin slid a big 11% after its Q2 profit got hit by over $1.7 billion in special charges. So how do these actual corporate hits, how do they square with the ongoing trade optimism we see in the market indices? It suggests maybe a split reality, where some companies are really feeling the tariff pain directly, even while the market bets on future deals.
That's a really stark contrast. A reminder that market sentiment and corporate reality aren't always aligned, especially with tariffs involved. Okay, so against that backdrop, real hits for some companies, broader market hope. How is the even bigger shipping industry coping? Let's look at giants like Maersk. They're dealing with these U.S. plans for hefty fees on China-built or operated ships coming into U.S. ports starting in October. But Maersk's response is interesting. They say they won't raise prices for customers or ditch Chinese shipyards. They claim they can just reassign 10% of their fleet to avoid the extra cost. That sounds like, significant flexibility.
It really does. And that flexibility shows how adaptable the industry is trying to be. What's also insightful from the sources is the skepticism within the industry about how these port fees will actually work out, given, recent policy changes and flip-flops from the U.S. government. Clients are apparently more worried about the immediate impact of U.S. tariffs on their businesses. That's the more direct threat they see. And the trade war definitely caused turmoil in shipping. We saw China's exports to the U.S. just plummet down 21% in April, then a huge 34.5% drop in May after those big tariffs hit. Then, followed by a surge in cargo from late May, when that 90-day tariff rollback happened, it really shows the direct volatile impact these policies have on the ground, much more than potential future port fees.
So if shipping is seeing that kind of volatility and direct tariff pain, what does this mean for companies like Maersk and the whole global shipping scene? How are they managing when air cargo seems, relatively speaking, calmer?
It means they have to be incredibly adaptive and proactive. Both Maersk and MSC, another huge player, have shown remarkable flexibility. Maersk, for example, adjusted ship sizes, kept its network structure the same, but matched capacity to demand changes. MSC managed disruptions using a new, independently run east-west network they launched back in February. Gives them a lot of flexibility, faster response, and beyond just moving ships around, companies are pushing harder on providing full end-to-end logistics, integrating rail, shipping, warehousing, road transport, offering the whole package.
Like that new Maersk warehouse in Shanghai.
Exactly. That new huge Shanghai warehouse, a $174 million investment, nearly 15,000 square meters. It's set to open in Q4 this year, a major regional distribution hub. So if you connect this to the bigger picture, it really shows how the entire logistics ecosystem is building in ways to adapt, adapting to global market shifts, political uncertainty. Even if air cargo rates seem relatively calm right now in this quiet patch, they're definitely preparing for bigger shifts down the line.
Okay, so let's wrap this up for the listener. You've heard that while global air freight rates are kind of stable, in a quiet season, there are these interesting regional pockets, some routes soaring, others dipping. At the same time, the bigger macro market is buzzing with trade deal hopes. Yet, major companies are still feeling the very real sting of tariffs on their bottom lines. Why should you, the listener, care about this really mixed, almost contradictory picture? What does it actually tell you about global trade right now?
Well, stepping back again, that quiet season for air freight, it might just be a moment of calm, maybe deceptive calm before bigger shifts kick in, driven by these macro trade developments. The strong performance we saw on certain European and Asian air routes, even while the overall market is flat, that suggests some specific resilient trade flows, maybe new pathways forming that are worth watching. And the strategies we see from shipping giants like Maersk and MSC, it really underlines how companies are building adaptability, resilience right into their core operations, trying to navigate this ongoing uncertainty, whether it's tariffs, demand shifts, or geopolitics. So critical thinking is key here, right? It's not just about the headlines or simple ups and downs. It's about understanding the forces underneath and seeing how the logistics industry is responding proactively, becoming more agile. That's where the real insights are.
Right. We've navigated through what seemed like calm waters in this week's global air freight rates, only to find ourselves right in the middle of these swirling currents. Trade deal optimism, very real tariffs impacts hitting companies, and this incredibly adaptive broader logistics sector.
Which really leads to a final thought, a question for you to think about. Given all these complex, sometimes contradictory forces, small dips in global air freight, but big surges on key routes, trade deal hopes versus real tariff pain, a shipping sector becoming super flexible, what might be the next big disruptor or innovation in global logistics? Not just air freight, but the whole system. What could emerge from these dynamics? And maybe more importantly, how might you prepare for or perhaps even capitalize on these evolving trends in global trade and supply chains in the coming months and years?